You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, the destructive force of fragility. Yes, fragility in nature is a dangerous characteristic. It's also, in a financial sense, similarly dangerous. We're going to discuss that on today's program. If you'd like to join us to talk about your portfolio, a specific stock, ETF, mutual fund, or investment strategy, 844-305-7800 is the number. Do give us your first name along with your city. This is a live program. We congregate every week here to discuss the birds and the bees of successful investing. At Index Show is my Twitter handle. You can tweet the program live and follow us. Again, that's at Index Show on Twitter. So taking a look at financial markets since the start of the year, a pretty good start thus far in 2019. We see the total U.S. stock market as tracked by the Schwab U.S. Broad Market ETF, ticker symbol SCHB, ahead by just over 4% thus far in 2019. We see the total U.S. bond market up about 15 basis points or 0.15%. The real estate market's doing pretty good globally. REET follows global real estate companies. Now, when we say global, that also includes the U.S., up almost 5% since the start of the year. Commodities have also had a pretty good start to 2019, ticker symbol USCI, ahead by 2.24%. And then we've got two other areas within the equity market, international stocks and emerging market stocks, which are both up in the area of about 4%. VEA and VWO. So all around, we're seeing a rebound from the very rough final part of 2018. And the question is, will the equity market globally be able to continue the momentum and the recovery? So there's many things, of course, that I watch and look for. And, you know, I tell you about this all the time on the show. One of the things we look for is volatility. Volatility really tells us about the market's expectation for at least the near term for potential downside in stocks. Now, we see volatility basically pulling back, and usually you see that when stocks are rising. See, there's an inverse relationship between stock market volatility and between stock prices. So for the most part, and there was a study on this done several years ago that explored the relationship between stock market volatility, in other words, ups and downs or gyrations, and stock prices. And what the study found is that about 80% of the time, you'll see an inverse relationship or opposite relationship between stock market volatility and stock prices. So what that means, for example, is when we see stock prices up, for the most part, at least according to the study, 80% of the time, volatility will be down. And conversely, if stock prices are down, volatility will be up. Well, since the start of the year, the VIX, which is a widely followed barometer of stock market volatility, VIX has sunk almost 30%. So we're seeing a pullback there. And, of course, now the focus becomes on earnings. S&P 500 companies for this first quarter will be reporting fourth quarter earnings. And maybe we'll get into this a little bit later in the next segment, discussing that what this portends for S&P 500 companies, because we have some news on the percentage of companies that have issued negative guidance versus those that have issued positive guidance. So I'll share that with you in the next segment, and that'll kind of give you a preview of what to expect for corporate earnings in S&P 500 companies. Also coming up a little bit later, we're going to drill down and take a look at what's happening in some of the key industry sectors within the S&P 500. Stay tuned for that. And then the focus on today's show is going to be fragility, or what we call a dangerous characteristic, not just in nature, but also inside your investments and retirement plan. Fragility is a very, very dangerous thing. And I'm going to explain this to you more in depth. And we're also going to talk about the antifragile, which is the opposite of fragility. We're going to talk about the antifragile framework and what that means and how you can apply this, the real world benefits of having an anti-fragile approach. And of course, the whole anti-fragile concept, there was a book written by Nassim Taleb, a philosopher, a scholar, an academician, and a lot of his work tends to be very philosophical and wordy and very deep thinking. And the difficult part with that, it's not for everybody, but the difficult part with that is finding a real world application. And so we're going to take that anti-fragile framework and explain to you how it can be applied inside your investment strategy on today's program. So a lot to get into. 844-305-7800 is the number. If you'd like to join us, we're here. How did your investments perform in 2018? Have you even started to receive some of your account statements? And are you scared of what you're seeing? Call the program. Tell us what's going on. 844-305-7800. @Index Show is my Twitter handle. I was talking with a friend in Chicago. He sent me a text. He was all panicking. He got his 2018 statement for the fourth quarter. And he's like, Ron, I'm down $20,000 in just a matter of a couple of months. And what's going on? And, when am I going to recoup this money? And, I proceeded to explain to him, hey, listen, that doesn't sound like anything odd at all. A lot of people were down even more than that. And so it's nothing strange or unusual. I mean, we just lived and survived through one of the worst quarters since the financial crisis of 2008. And probably I have to take a look at the history, but one of the top three for sure, maybe the absolute top worst quarter for stocks in the history of the stock market. That's what we just went through. I mean, it was just absolutely brutal, not just in the broad stock market and the broad indexes, but also in key industry sectors like technology and financials, and even some of those defensive sectors like consumer staples took a hit. So it doesn't shock me, it doesn't surprise me. And then my next question to him was, well, how long do you have to go before you hang up the cleats and retire? Because his immediate concern was, well, when am I going to recoup these losses? And I subsequently explained to him, well, listen, you're not going to be retiring in the next 5 to 7 years. You've got a lot of time to recover. And the real question is, nobody knows when you're going to recover those losses. But the point is to have a asset mix that you're comfortable with, and also an adequate margin of safety. In other words, a cushion within your portfolio that stabilizes your investments and also stabilizes your emotions when financial markets go haywire. And so that's something that he's looking at, and I'm, of course, helping him to identify some of those potentially weak spots so they can be shored up. So these are the exercises that rough waters help us to push forward on and look at. This is the Index Investing Show. I'm Ron DeLegge. More when we return. I'll be right back.
The Index Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
All right, here's another thing I look for in terms of trying to determine the overall health of the stock market is how are the industry sectors performing? In other words, taking a look at the underlying pinnings of what's driving stock prices. And so if we take a look at this from a sector perspective and a sector angle, we've got currently 10 S&P 500 industry sectors. And of course, you have ETFs, the sector spider ETFs following each of those 10 sectors. And some of those sectors, for example, represent a very big portion of the S&P 500's overall allocation or mix. For example, technology is a very big sector within the S&P 500, so are financials. But if we take a look at this from a sector perspective, we've got all 10 industry sectors within the S&P 500, 500, the broader index, now up in 2019. They're all positive. And that is very telling about the rebound that we're currently experiencing, which is quite a relief, to say the least, especially after that beatdown in 2018 in the fourth quarter. But if you take a look at, for example, some of the leading sectors, you've got industrials, ticker symbol XLI, ahead by just over 5%. You've got this consumer discretionary sector ahead by almost 5.75%. Those are top performers. And then the top performing industry sector thus far in 2019 within the S&P 500 is communication services. So I'm opening my Select Sector Spider ETF app, and it's available at the App Store, Apple's App Store. So I'm opening it up, and it's an excellent app. I follow it and use it on a daily basis, and it tells me exactly what each of these industry sectors are performing, what their components are, and also the strategy or idea behind each sector. For example, communication services is following companies in the telecommunications area, media, wireless, entertainment, along with internet media. So it's got currently 26 stocks, and the ETF following it is XLC. So whatever those 26 stocks do, XLC is going to perform accordingly. The current expense ratio on XLC, that's the fee, the annual fee in order to hold this fund, is 0.13%, so 13 basis points. And then if we take a look at some of the top holdings inside XLC, the top 5 holdings are companies you've never heard of. Number 1 is Facebook. Number 2 and number 3 is Alphabet, formerly known as Google. And then you've got Netflix and AT&T. So those are the top 5 holdings in XLC. Like I said, companies you've never heard of. So these are the world-class components of XLC. And then when we look at it on a broader picture, XLC, of course, is just one industry sector within the overall S&P 500. But again, that is the number 1 performing industry sector thus far in 2019 within the S&P 500. That is the communication services industry sector. 844-305-7800. That is the number. I'm Ron DeLegge. This is the Index Investing Show. We're here. How are you doing thus far in 2019? How did you do in 2018? You're just probably starting to get your statements. And are you scared at what you see? What went right? What went wrong? What changes do you need to make? These are all questions I want you to reflect on. Taking a look at some of the stories I'm following on our Twitter feed, we've got a link to our program from last week. Just by way of reminder, every single show that we do, we archive as a podcast. And last week's program, we talked about financial resolutions for the new year and why I say skip it. Financial resolutions are overrated. Skip it. So you can listen to that particular episode by hitting our Twitter feed at Index Show. I've got a link to that. We've also got something a little bit more on the technical side. It's a retweet from a fellow by the name of Ryan Detrick, and he had this to say: the last time the McClellan oscillator went from negative 80, that's super oversold, to plus 80, that's super overbought, within 2 weeks, and he has that in the form of a question. The last time we went from super oversold within the stock market to being super overbought was March of 2009, and it just happened this past week. I don't remember what happened in March 2009. Do you? Can anybody remind me what happened in March 2009? Because I'm suffering from some amnesia, and I can't recall what happened in March of 2009. Because I don't remember anything about history, because I like to repeat it and just be doomed. Be doomed to repeating my colleagues of my predecessors, so to speak. Does anybody remember what happened in March 2009? Because whatever happened then just happened this past week. Stocks went from super oversold to super overbought. That's on the Twitter feed at Index Show. And then also, I've got a link here. The Federal Reserve Chairman, Jerome Powell, said that he's very worried about ballooning debt in the U.S. He said, quote, "It's a long-run issue that we definitely need to face and ultimately will have no choice but to face." Are you aware that the U.S. government, and this is also on my Twitter feed, this is actually a like. This was one of my favorite likes of this past week. It took 235 years for the U.S. government to accumulate its first $10 trillion in debt. And in only 9 years, the U.S. government's already added $12 trillion. So we're now up to $22 trillion in national debt. And it's been increasing government debt, at a rate of 4-to-1 to GDP. But the GDP has become reliant and a dependent variable on the debt. So that's something to really think about. The national debt, and of course even bigger than that is the unfunded liabilities, Social Security, and Medicare. Multi-trillion-dollar unfunded liabilities. You add all of that up together, and you're looking at, depending on whose math you believe, we're just under $100 trillion or just above that. Either way, it's an unfathomable number. And as Jerome Powell says, it will have to be dealt with. It will have to be dealt with. Of course, the politicians in D.C. are focused on other matters at this time, right? They're always kicking the can. But you see, from a retirement planning perspective, this is why the philosophical approach to retirement planning on this program is we'd rather pay taxes at today's low rates versus in the future when they're guaranteed to be substantially higher. And that's just the fact. We'd rather not pay any taxes at all, right? But that's part of the being a U.S. citizen, right? We have to. There's a cost to everything, right? And we have to obey Caesar, per the biblical words of the Romans, right? Because that's the law, right? We have to pay our taxes. We can't evade them. But if we're going to do that, we need to, in the context of retirement planning, we need to have some sense of that. It's got to be a plan behind it. And so these are the things we're trying to make you aware of. Roth IRA, baby. Roth 401k. Roth conversions. We're in a honeymoon period before higher taxes arrive. So take advantage of it. Coming up next, the Antifragile framework. Be here, be nowhere.
The Index Investing Show with Lon DeLegge.
Trading is different than investing, but the opportunity to take advantage of short-term trends is only one if you get the direction right. Direction leveraged and inverse ETFs offer bold trades on U.S. and international stocks and bonds. Don't miss your next big trade. Direction leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foresight Fund Services, LLC.
With more than 2,000 ETFs in the U.S. market, finding the right funds is more complicated than ever. ETFguide.com simplifies your life by sending you free guides on the top ETFs. Sign up at etfguide.com/snapshot. Choose from our library of free guides covering commodities, inverse, and leverage funds, along with new ETF launches. Our carefully screened ETF guides will save you time. Sign up at etfguide.com/snapshot.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
All right, welcome to the program. 844-305-7800 is the number if you'd like to join us to talk about anything financial on your mind, particular investment strategies, stock, mutual fund, ETF. Again, 844-305-7800. You can tweet the program at Index Show. You can follow us there. Some of the things that we talk about on the program, we link directly to. And, you know, I love Twitter because it's really a bastion and a place where I collect ideas and share them with you. And also news stories that I think are important. So I filter out, I think, what the media is spewing out. I filter out what I think is important, and I share that with you on our Twitter feed at Index Show. Again, is the Twitter feed. So those are things that we alert you about. Now, in terms of getting back to the stock market's mood or health, before we start talking about the Antifragile framework, a couple of other things that I'm tracking. We already told you about volatility, which has really come down. That's a good sign for stocks. Also, we've got all 10 industry sectors within the S&P 500 in positive territory thus far in 2019. That's a positive sign. We also see the Fear and Greed Index from CNN, which shows that fear is subsiding. Now, we're still in a fearful reading. Now, remember, the Fear and Greed Index, 0 is extreme fear. 100 is extreme greed. Last quarter, we were under 10. So we traded between 0 to 10, which was at very extreme fear levels. Right now, we're at 30. Remember, extreme fear is 0. Extreme greed is 100. If you get to close to 100, you're in extremely greedy territory. Right now, we're at 30. We're nowhere near extremely greedy. There's still a lot of fear in the market, even though we're recovering. And this is a pretty neat index that I like to refer to because it takes a multiplicity of indicators. They extract 7 key indicators that help them to calculate this, like put and call options, market volatility, safe haven demand, junk bond demand, stock price breadth, and stock price strength, and also market momentum. So it collects all that information and looks at it in unison, and then it spits out a reading. So that's helpful. Now, in terms of corporate earnings for the fourth quarter of 2018, now remember, fourth quarter earnings get reported in first quarter, which is where we're at right now. So in terms of S&P 500 companies on the earnings side, thus far 106 S&P 500 companies have issued earnings per share guidance for the fourth quarter. So then the question becomes, well, what has the guidance been? Has it been positive or negative? And of those 106 companies, according to FactSet, 72 have thus far issued negative earnings guidance, while 34 have issued positive guidance. So far more companies are issuing negative guidance than positive. And so the question then becomes, what will they actually report? Will they beat already beaten down expectations? That's something else to watch for. Apple issued an earnings warning, right? I think it was on January 2nd. They revised their guidance for fiscal 2019 first quarter, and they expect to have revenue much less than what was originally projected. So that sent the whole tech industry sector spiraling. And actually, that's where we see the most negative revisions or negative guidance is within the technology sector. Ticker symbol XLK follows that. So far, there's been 19 companies that have issued negative earnings per share pre-announcements. The next sector, which has the largest number of pre-announcements in terms of negative earnings, is consumer discretionary. That's ticker symbol XLY, and includes companies like Amazon.com, and that is the next sector with the largest number of negative guidance. So those two sectors, those are areas to watch for. XLY, consumer discretionary, and then XLK. 844-305-7800 is the number. This is the Index Investing Show. We're here. You're there. And, of course, we're here every week at this same hour. By way of reminder, 2019 is here, and it's important to have a robust investment plan. So we're going to help you with that. You can enroll in Ron DeLegge's online classes. All you got to do is go to indexshow.com. I've got 4 online classes that will give you the skills you need to make prudent and informed investment choices. So go to indexshow.com, and you can just click on the enroll button, and that will link you over to my online classes. Now, let's talk about the anti-fragile nature of the investing and contrast that with fragility. So, as I indicated earlier in the show, fragility is dangerous. Dinosaurs, for example, were large and powerful, but they still died. Why? There's no shortage of theories of what led to their extinction, but we do know that dinosaurs' inability to adapt and survive major shocks was a contributing factor that led to their extinction. So one of the major lessons among many is that being large and powerful all by itself is not a guaranteed formula for survival and just as importantly, for thriving. So the anti-fragile framework, which is discussed in Nassim Taleb's book, kind of discusses this and covers it. Fragile things are easily impacted, negatively impacted by disturbances. So these disturbances include chaotic events, unpredictable shocks, or what I like to refer to as black pianos falling from the sky. Volatility. These are all things that fragility is negatively impacted by fragile investment portfolios. Fragile objects, by definition, are easily broken during periods of chaos. Think about, for example, how a delicate vase reacts during an earthquake. The vase is easily damaged with just one violent shake. Now, it's irrelevant how beautiful the vase looked before the earthquake or how long it took the artist to design the vase. That doesn't matter. The vase, because of its fragility, falls victim to the destructive forces of the very fact that it's fragile. Getting back to dinosaurs, the extinction of certain creatures from nature provides ample evidence that fragility is a destructive force. And there were other fearsome species like the saber-toothed tiger and the thylacine that suffered a similar fate. For whatever reason, their fragility led to their permanent demise. So from an investment perspective, let's connect this. The loss of capital caused by external shocks extinguishes money in a freely built portfolio. So in the context of a person's investments, your investments, my investments, whether they be for retirement or for another purpose, fragility is an acute threat to your well-being. At the opposite spectrum of fragile are things that resist the dangerous forces of fragility. Moreover, these things go even one step further than that. They gain from chaos. And that's where we can arrive at the spot which is called anti-fragile. We describe these sort of things or objects as anti-fragile. They don't just resist shock and chaos, but they actually gain from it. Can you imagine that? So we're going to talk about the benefits of the anti-fragile approach, and I also want to give you some real-world application and talk about anti-fragile assets that benefit from turmoil. Can you imagine that? They go up. This is the Index Investing Show. I'm Ron DeLegge. I'll be right back.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
So, talking about the anti-fragile approach, the benefits of designing an anti-fragile investment portfolio, I think, are only appreciated when everything seems to be going wrong. So, instead of breaking during times of massive chaos, massive volatility, and a multiplicity of disorder, what happens is the anti-fragile portfolio actually benefits. As I described earlier in the show, it doesn't just remain stable, it actually gains from chaos. So while the fragile portfolio is vulnerable to losses, the anti-fragile portfolio is actually poised for gains. So rather than describing the overall framework of how to build an anti-fragile portfolio, which is something I do in my online classes, Build, Grow, and Protect Your Money, a step-by-step guide. Also, my other class, Profit During Crashing Markets, a step-by-step guide. I want to focus on the bits and pieces of the anti-fragile portfolio. I want to focus on the components of the anti-fragile portfolio. What are anti-fragile assets? What are things that benefit from turmoil? What are things that gain? Well, I'm going to help you with that. So there's a couple of things that come to mind. Number one are put options. Put options are, by their very nature, designed to increase in value when the underlying assets, whether they be stocks or ETFs, decrease. So put options benefit, and we might describe them as anti-fragile assets. Inverse ETFs are another example of anti-fragile assets because they gain, they benefit from turmoil. So some of those ETFs from direction investments that we talk about quite often on the program that are inverse or opposite, those we could describe as anti-fragile assets. By the way, the first quarter report is coming out, and it's going to have all of the leveraged and inverse ETFs neatly categorized according to how they invest. We separate them by their asset class, equities, bonds, real estate, commodities. So if you want to get that, go to etfguide.com/snapshot and sign up. It's a free report, and it'll be delivered to your inbox. And we expect that to be released later this month. So don't miss that. It's a very, very helpful guide that will help you find very quickly the inverse or leveraged ETFs you're looking for. So the next type of anti-fragile asset would be volatility ETFs. So these are ETFs that track, for example, the VIX index. And if the VIX is going up, these ETFs are designed to follow that. So by design, they should increase in value. And then, of course, volatility call options. So this would be buying, for example, call options on the VIX index. And if there's chaos, you're going to see that volatility index shoot up, shoot higher. And so these are 4 examples that I give you of anti-fragile assets: put options, inverse ETFs, volatility ETFs, and volatility call options. These types of assets gain from chaos. They gain from turmoil. And so the real world application here, I know the philosophical roots of the anti-fragile investing strategy might sound complex. And it might sound like, well, listen, I can't execute this. It's too over my head. But what's important to remember is that the orientation of an anti-fragile portfolio, it's something that happens deliberately. You take deliberate steps to make that happen. And you don't have to have your entire portfolio be anti-fragile. In fact, in my framework for how I teach you to build an investment portfolio, we would never, ever build 100% of the portfolio to be anti-fragile, right? Because remember, there's 3 components to an architecturally sound investment portfolio within the Ron DeLegge framework, okay? In the core of the portfolio, right, is indexed using broadly diversified index ETFs that touch the major asset classes: stocks, bonds, real estate, and commodities. Those are the 4 major asset classes. So that's your core. Your non-core portfolio can be more strategic in nature. It can invest in anti-fragile assets. So that would be the portion of your portfolio, if we're talking real-world application, that could be designated as anti-fragile. So within this portfolio construction prototype, you can own assets like put options, inverse ETFs, volatility ETFs, volatility call options within your non-core portfolio. You would never own those types of anti-fragile assets inside your core portfolio. Never. Because the core portfolio is your foundation. It's designed it's not designed to be strategic in a sense. It's not designed to be anti-fragile. It's designed to give you broad diversification to the major asset classes. There is no market timing happening in your core portfolio. It's pretty much fully invested at all times. But the non-core can be the anti-fragile aspect of your portfolio, because those types of assets, if there's chaos, if there's turmoil, if there's a bear market, will benefit. They won't just stay stable. They are designed to increase or gain from that chaos. And so the non-core portfolio is where you can employ the anti-fragile strategy. Now, remember, there's one other portion of the portfolio, because Ron DeLegge's framework for portfolio construction has 3 components: the core portfolio, the non-core portfolio, which we just discussed, and then do we remember what that final component is? Yeah, that's called your margin of safety. Your margin of safety is the portion of your portfolio that's earmarked for capital preservation, 0 volatility, and 100% liquidity. So that's your margin of safety. And as you get closer to retirement, what should happen is your margin of safety, your cushion, should become larger, because your ability to absorb large financial losses or shocks becomes less and less as your investment time horizon compresses or gets shorter. So that's why your margin of safety should, little by little, get larger. But remember, the margin of safety aspect or component of your portfolio is very different than the anti-fragile portion or non-core portfolio, because the margin of safety in a chaotic market, in a market that has turmoil, in a world that has lots of volatility, the margin of safety will provide you stability. It won't necessarily gain from all of that instability or all that chaos, but it will provide you the stability that you need. But it's the anti-fragile assets that actually go up in value. They don't just stay stable. They're designed to go up in value. Now, there is a little bit of a caveat that I need to share with you about anti-fragile assets. As good as all of this sounds, anti-fragile assets are not immune to losses. They are not immune to losing value. And in fact, when we've got a financial markets like we had in 2017 that were very calm and that went steadily higher, you saw some of these anti-fragile assets actually lose value and go down. So just because something's anti-fragile, I know there's a lot of proponents who promote this type of investing for 100% of your investments. What they don't tell you is that anti-fragile assets are susceptible to losses in a market that is steadily climbing or a market that has low or zero volatility. So these are things that I want to make you aware of. And if you'd like to read more, I've got a full-blown article that I wrote all about this at etfguide.com. It's on my Twitter feed, @IndexShow, and the title of that article is The Destructive Force of Fragility. Well, that does it for another episode of the Index Investing Show. Be sure to join us again next week, same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.